Every single day, trillions of dollars move around the world in seconds. Fortunes are made, fortunes are lost, and most of it happens because of one thing: a number going up or a number going down on a screen. But here's the strange part. Ask 10 people what actually makes a stock price move, and you'll get 10 different answers. Most of them will be wrong. Today, we're fixing that. By the end of this video, you'll understand how the stock market actually works. Not the textbook version, the real one. The one that explains why your favorite company's stock can crash even when it just posted record profits. Quick thing before we dive in, hit subscribe so you don't miss what's coming after this one. Let's get into it.
Well, let's start at the very beginning. What is a stock? Picture 3 friends who build a food truck from scratch. One puts in the cash for the truck, one puts in the recipes, one puts in the labor, and they agree to split everything 3 ways. If the truck earns money, they each get 1/3 of the profit. If they ever sell the business, they each get 1/3 of the sale price. That's it. That's a stock. It's just a receipt proving you own a slice of something that makes money. Now, fast forward 10 years. That one food truck is now a chain of 500 restaurants across the country. To keep growing at that scale, the owners need more cash than any bank is comfortable lending. So instead of taking on more debt, they do something bigger. They offer tiny slices of the entire company to the public. For the first time, a complete stranger, anywhere in the world, can own a fraction of that empire without ever flipping a single burger. That's essentially what a company does when it goes public. And the tool it uses to do that is called an IPO, an initial public offering.
Here's how it works in simple terms. The company hires a bank, usually a big investment bank, to help figure out how much the whole company is worth. Based on that, they decide how many shares to create and at what starting price. Let's say the restaurant chain is valued at $100 million, and they decide to split it into 10 million shares. Each share would be worth about $10 at launch. On IPO day, those shares go on sale to investors for the first time. From that point on, the company doesn't control the price anymore. The market does. And that's where things get interesting. Because once shares start trading between everyday investors, the original $10 price becomes almost irrelevant. What matters now is something else entirely: what other people are willing to pay for it. This is the part almost nobody explains properly. The stock price is not set by the company. It's not set by some committee. It's set by supply and demand. Literally, buyers and sellers negotiating in real time. Think of it like an auction that never stops. If more people want to buy a stock than sell it, the price climbs because buyers start offering more to convince sellers to let go of their shares. If more people want to sell than buy, the price drops because sellers start accepting less just to get someone to take the shares off their hands. Every stock exchange, the New York Stock Exchange, the Nasdaq, runs on something called an order book. It's essentially a giant, constantly updating list of I want to buy at this price and I want to sell at this price. The exchange's computers match these orders together thousands of times per second. So when you see a stock price on your phone, you're not looking at some fixed value. You're looking at the very last price at which a buyer and seller agreed to trade.
So, if it's just buyers and sellers, what makes people suddenly want to buy or sell more of a stock? A few key things. First, earnings. Every 3 months, public companies report how much money they made. If a company beats expectations, more investors want in, and the price often rises. If it misses expectations, even slightly, the price can drop fast, sometimes within seconds of the report. Second, news and expectations. Markets don't just react to what happened, they react to what people expect to happen. A company can report record profits and still see its stock fall because investors expected even more. This is one of the most misunderstood parts of investing. The market moves on expectations, not just facts. Third, interest rates and the broader economy. When borrowing money becomes more expensive,
businesses grow more slowly, and investors often shift money out of stocks into safer options. This is why a single announcement from a central bank can move the entire market in one day, even for companies that have nothing to do with banking. Fourth, and this one surprises people, psychology. Fear and greed drive huge amounts of short-term movement. When investors panic, they sell, which pushes prices down further, which causes more panic. When investors get excited, they buy, which pushes prices up, which attracts even more buyers. This is where the terms bull market and bear market come from. A bull market is a period of rising prices and optimism.
A bear market is a period of falling prices and fear. Here's something most people never think about. When you buy a stock, someone else is selling it to you. When you sell, someone else is buying it. Every single trade needs two sides. That someone else could be another individual investor. It could be a massive pension fund managing retirement money for millions of teachers or government workers. It could be a hedge fund. It could be an algorithm executing thousands of trades a second based on pure math with no human involved at all. This is important because it explains why the market can feel unpredictable. You're not just trading against regular people like yourself, you're trading in a pool with some of the most sophisticated financial institutions on Earth. That doesn't mean you can't succeed as an individual investor. It just means chasing short-term price swings is a much harder game than it looks.
So, if picking individual stocks is difficult, even for professionals, how do everyday people actually build wealth in the market? The answer for most successful long-term investors is something called an index fund. Instead of betting on one company, an index fund buys a small piece of hundreds of companies at once. The most famous example is the S&P 500, a fund that holds the 500 largest publicly traded companies in the United States. Here's why this matters. Instead of trying to guess which single company will win, you're essentially betting on the overall growth of the economy over time. And historically, despite crashes, including the two we've already covered on this channel, the Great Depression and the 2008 financial crisis, the market has always recovered and grown over the long run. To put a number on that, going back roughly a century, the S&P 500 has delivered an average annual return of around 10% before inflation. That includes the Great Depression. That includes 2008. That includes every crash in between. 10% a year doesn't sound dramatic, but thanks to compounding, money that grows at that rate roughly doubles every 7 to 8 years if left untouched. This is also why so many financial experts say the same thing. Time in the market beats timing the market. Trying to predict short-term ups and downs is incredibly difficult. Even professional fund managers routinely fail to beat the market consistently.
Staying invested for years, even decades, has historically rewarded patient investors far more than those trying to catch the perfect moment. Let's clear up a few things people consistently get wrong. Myth 1. The stock market is rigged against regular people. The market has real risks, and yes, large institutions have advantages in speed and information. But millions of ordinary people have built genuine long-term wealth simply by investing consistently in diversified funds over time. It's not a guaranteed win, but it's not a rigged casino either. Myth 2. You need to be rich to start investing. This used to be more true. Today, many platforms let you invest with just a few dollars, and you can buy fractional shares of expensive stocks. The barrier to entry has never been lower. Myth 3. A falling stock price always means a bad company. Sometimes prices fall simply because the broader market is down, or because expectations were too high.
Not because the business itself is failing. Myth 4. You have to check the market every day to succeed. For long-term investors, obsessively checking prices daily often leads to emotional decisions, panic selling during dips, or chasing hype during rallies. Historically, a calm, consistent approach has outperformed a reactive one. So let's bring it all together. A stock is simply a slice of ownership in a company. Prices move because of buyers and sellers constantly negotiating. influenced by earnings, expectations, interest rates, and plain human psychology. And for most people, the smartest long-term approach isn't picking the next big winner. It's owning a small piece of the entire market and staying patient through the ups and downs. Understanding this doesn't just make you a smarter investor, it changes how you see the news, the economy, and every red or green number you scroll past for the rest of your life.
Now here's the truth. Knowing how the market works is step one. Most people never even get this far. If you made it this far in the video, you're already ahead of most people who call themselves investors. So here's what I'd ask of you. If this video actually made things click, don't just scroll past. Hit that like button. It genuinely helps this channel reach more people. And subscribe so you don't miss what's coming next. And drop a comment telling me one thing from this video that surprised you. I read every one of them, and it genuinely shapes what we cover next on this channel.